Hey, Matt Decker, Leveraged Wealth Management. Today I'm going to be starting a new series on premium financed life insurance. Now I'm going to tell you up front, this series is not going to apply for everybody because this only works for a specific subset of clients. But the reason that I'm going to be talking about it is because potentially this strategy could be one of the best pieces of your portfolio, and conversely, it can also be one of the worst pieces of your portfolio. If this strategy is done wrong, it can be absolutely devastating. And unfortunately, this strategy comes with really high commissions to the brokers that sell it. And so there's an incentive to push this premium finance life insurance concept to people that maybe don't qualify, number one, that don't understand the risks, number two, and there's a big incentive to make these strategies look more impressive or more beneficial than they really are by using unclear or unrealistic assumptions. So this series is going to go into all the nuances of premium finance life insurance. We're going to look at some case studies where policies were done right. We're going to look at some case studies where policies were done wrong. And I think you'll see that there's a huge difference between the people that really do qualify for this program, that this is going to benefit, and the people that maybe shouldn't even consider this because it's too risky, they don't have enough liquid assets. And hopefully, after watching this series, you'll come away with an understanding of what premium finance is, whether or not it's right for you. And if you already have one of these strategies in place, you will know whether or not your strategy was put in place by somebody who knows what they're doing, who's looking out for your best interests, versus trying to make a huge fat commission by positioning a concept or a strategy that's maybe unrealistic. So this video is just going to be the intro to premium finance, what it is, how it works, and maybe why it makes sense. So let's start with the idea of financing things in general. We finance all kinds of things in our everyday lives. You probably financed a house at one point in your life. You've probably financed a car. Here's my best drawing of a car. Oh gosh, that's terrible. You probably financed a car, you financed a house, you finance all kinds of things. And when you finance, all you're doing is you're taking money from a bank, and you're taking the money from that bank to purchase things like the house and the car. And in turn, you pay the bank back the principal plus some interest. I'm not telling you anything that you don't already know. So you're used to financing things in real life. Now, there's a whole bunch of reasons that you might want to finance the purchase of a house or the purchase of a car by using funds from a bank. One might be, you don't have the cash needed to put down all the money for a house, or you don't have the cash needed on hand to buy a car. The other reason to finance things in real life is, let's say that you've got a bucket of money over here, and this bucket of money is earning something like 10 to 12% every single year. Well, you could certainly dip into your bucket of funds and you could buy that house or you could buy that car. But if the house or the car doesn't appreciate in value faster than your 10 to 12% bucket of money is appreciating, well then you're kind of losing money every time you decide to dip into that bucket to make purchases that don't appreciate as fast. So if you can use money from a bank at, say, 3 to 6%, instead of taking money out of your bucket earning 10 to 12, you're actually making money by the use of finance or leverage, because you're not having to dip into your high performing assets. So that would be another reason that maybe a high earner or a high net worth individual might finance a purchase versus dipping into their assets to buy things with cash. And the same holds true for things like life insurance. The most common client for premium finance strategies are going to be high net worth individuals. And the reason that this is the most common is because high net worth individuals, and when we say high net worth, we're talking 10 million and up. And the reason that we're talking 10 million, and this is net worth. The reason we're saying 10 million and up in net worth is because there's a good likelihood that these individuals will face some type of estate tax. Now, it could be state, it could be federal. Right now, the federal estate tax is north of $20 million. So obviously, from an estate tax standpoint on the federal level, somebody with a $10 million net worth today doesn't have a federal estate tax problem. But if their estate is growing at something like 10 to 12%, shoot, even if it's just 5%, and they're relatively young, let's say that they're 60 years old, and they've got another 25 years before statistically they pass away. If their assets are growing at any moderate rate of return, let's just say that it's growing at 5%, and let's use 20 years. So 20 years down the road, a 60-year-old is going to be 80. Their life expectancy goes pretty much well beyond that. But at a 5% growth rate, worth $10 million today, 20 years from now, they're going to be worth $26 million. Now, let's assume for a second that the estate tax stays where it is. In this example, you're going to have anywhere from a $2 to $6 million estate tax, and that's going to be taxed at around 50%. That, of course, assumes that the estate tax threshold stays where it is. A couple of years ago, the estate tax limit wasn't anywhere near the 22 to 24 million that it is today. It was down around $1 million. You've seen it around $5 million. You've also seen it around $10 million. In all of these scenarios, the estate tax that would be due on a $26 million estate is astronomical. So the question becomes, if you are going to have an estate tax problem, what's the best way to pay for that estate tax? Now, some people will use fancy trusts in order to reduce the overall size of their estate. Some people decide that they're just going to sell off assets and pay cash. But really, the most efficient way to pay an estate tax is with life insurance, assuming that you're healthy. Why? Because you get to leverage your dollars from day one, and the money goes tax-free, it grows tax-free, it passes probate if it's done correctly, and this can be the perfect way to leverage your dollars to pay for any potential estate tax. Now the question becomes, how then do you pay for your life insurance? Because if this is let's just say this needs to be a $10 million policy in order to completely pay for your estate tax burden. Well, a $10 million life insurance policy is going to cost a lot of money. So the question becomes, do you use cash to pay for this $10 million life insurance policy, or do you use something that people in the industry will call OPM, other people's money? That's a fancy way of saying using a bank to finance the purchase of your life insurance. Now, why in the world would this be a consideration, using a bank to borrow funds to buy life insurance to pay your estate tax? Well, in the case where maybe you're earning 10 to 12%, but really it doesn't even have to be 10 to 12% in your bucket of money. What if you're earning somewhere between 6 to 9% on your funds? Maybe you own real estate, and maybe that real estate is kicking out a 6 to 7% quote unquote dividend or income stream. In those cases, it could make sense to use a bank that maybe loans you funds to purchase life insurance at something like 4 to 6%, because you don't have to dip into your bucket of money. You don't have to take money out of your accounts that are earning a significant chunk of interest. Instead, you get to use leverage. So your money continues to grow at the favorable rates with which it's already growing. And all you have to do is make sure that you outpace the bank loan inside the life insurance policy. As long as your life insurance policy can make a higher average rate of return than what the bank is charging you to borrow the funds, this strategy is going to work perfectly. Now, there are tons of risks with this program. I am not going to get into the risks on this video. I'm going to have a whole separate video that simply outlines the risks involved with premium finance life insurance. It's a long list. It's pretty technical, but we're going to go into a deep dive on the risks. That is not the purpose for this call. I just want you to understand who this might be a fit for and why this might be a fit for those individuals. So let's really quickly just outline the mechanics of how this is actually working. There are two entities involved right off the bat. You have your lender and your grantor. The grantor is going to get a loan from the lender, and they're going to secure that loan with collateral. They're also going to establish a trust. This is known as an irrevocable life insurance trust, or ILIT. The ILIT is going to actually own the policy. The lender is not going to give money to the grantor. The lender is actually going to provide the loaned funds directly to the ILIT. The ILIT is then going to purchase the actual life insurance policy with the loaned funds. A portion of the policy death benefit is going to go to pay back the lender, and the ILIT is going to pay some interest to the lender on an ongoing basis. The cash value inside this policy is going to steadily grow if everything is done correctly and goes according to plan. And at some point, there's going to be enough cash inside this policy where you can actually pay back the lender using policy funds. And now this policy becomes free and clear, owned by the ILIT with no strings attached. And in order to get this policy, you had to service some interest while premiums were being paid, and you had to post collateral in order to back the loan. Sound confusing? Yeah, it absolutely is confusing. There are tons of risks with this, and that's why most of these policies are done incorrectly. It's a complicated sales process for a select few individuals that have a certain problem, a certain net worth, and a certain risk tolerance. If everything's done right, this can be phenomenal. It can be a great way to pay for things like estate taxes. If things are done wrong, you can see this collateral explode. You might start with $200,000 in collateral. 10 years in, if this is done wrong, this $200,000 in collateral can grow to $2 million in collateral. Again, if it's done wrong. So the important piece with premium finance life insurance is, number one, make sure that it's a strategy that you're actually qualified for. Make sure that it fits into your risk tolerance, because there are significant risks with this strategy. Make sure that it's being designed the right way, and make sure that the assumptions being used on the lender loan interest, as well as the amount of money that you're going to have to pay out of pocket in the form of interest and collateral, make sure that those are realistic assumptions, not pie in the sky numbers. So let's recap premium finance life insurance. Who's it for? It's for high net worth individuals. What are they doing? They're borrowing funds to pay for life insurance. In the interim, they're posting collateral to back the loan, and they're servicing the interest. If you don't like the idea of using other people's money, borrowing funds, this strategy is not for you. If you don't have collateral to post, this strategy is not for you. If you don't like the idea of servicing interest, this strategy is not for you. And if you don't have a significant net worth, this strategy is not for you. If you've already purchased a form of premium finance life insurance and you have not gotten a review on that strategy at least once a year, or if you suspect that your policy or your strategy was designed incorrectly using unfair or unsafe assumptions, you absolutely need to get a policy review that goes over the entire strategy, looks at the bank loan, looks at the policy that you're using, the assumptions that you're using, because again, if this type of strategy unravels on you, it can get out of control extremely quickly, and you will find yourself posting tons of collateral and paying tons more interest than you ever thought possible. So if you have this strategy and you haven't had it reviewed completely, I encourage you to do so. You can click the link above in the top right-hand corner of this video. It's going to take you to a web page where you can sign up for a review on your premium finance strategy. Now, these reviews take time. This is not something that can get turned around to you really even in the same week. And there are things that we need. So if you're going to apply for a review on your premium finance policy or your premium finance strategy, there's a couple things that you're going to need to have handy and ready to send to us. You're going to have your original policy illustration. That is the illustration. It's a 20 to 30 page ledger from the life insurance company itself that shows the assumptions that were used. You're going to need that. You're going to need a current annual statement or a current policy statement from the life insurance carrier showing how much cash is in the policy, how much death benefit the policy has, so on and so forth. You're also going to need the original bank sheet that shows the interest that you're scheduled to pay out of pocket. It shows the loan assumptions and the loan terms. We're going to need that as well. Those are the three things that we absolutely will have to have. And then in order to complete the review, after we get those three initial things, we're going to have to order an in-force illustration from the company itself showing how the policy is projected to perform going forward based on the results that you've already experienced. If you don't have access to those things, we cannot review your premium finance strategy, so you have to have those. Again, you can click on the link above, or you can go directly to the website, leveragewm.com/premium finance, leveragewm.com/premium finance. I will link it below and put it in the description as well. If you haven't already done so, like this video, subscribe to my channel. We're dedicated to providing unbiased, actionable advice on all of your cash value life insurance policies and needs. Thanks so much for hanging out with us. Make sure you tune in to the next couple videos in this series on premium finance life insurance, where we go through some bad designs, some case studies, the risks, and we'll show you a smaller premium finance design that's used more for actually retirement planning. So stay tuned for those videos that will be coming up in the next couple weeks. This has been Matt Decker with Leverage Wealth Management. Thanks for your time, and I look forward to talking with you soon.